Hey, Bulls and Bears, what is happening? It is Monday, October 24th, 2022. We've got a lot to get caught up on today. Thank you for tuning into that video I did over the weekend where I was at the mansion that was for sale. It was actually pending sale. A couple of you down in comments said, no, it's not selling. It's on the market. It's on the market, but it's pending right now. They're still taking backup offers, so it could still sell. It is still considered on the market, but it is pending sale right now, 2.8 million. So thank you for joining in on that one. Had a fun weekend. There goes the trash truck. As soon as I start the video, there goes the trash truck. Hopefully it's not too annoying. I'm going to go ahead and continue and not even edit that out. Let's talk about the economy. Economic news is continuing to come in fast and furious. The economic collapse continues to escalate. And the economy basically is the U.S. consumer. The U.S. consumer, most people are living paycheck to paycheck already. We saw a pause in 2020 with the unprecedented events, the rescue programs, the pausing of the evictions, the foreclosure moratoriums, all the other rescue programs that came out. That was unprecedented. Now we're back to where we were pre-pandemic, and the path to destruction continues to widen. And people are not getting out of debt. People are getting into deeper debt. The problem with that is the U.S. consumer is the U.S. economy. Most of the U.S. economy is consumer spending. So when interest rates rise and when debt levels are high and interest rates rise at the same time, you have big problems. We see it in the housing market. We see automobile prices starting to come down. Also, some other things are starting to show significant changes ahead and more deterioration in the coming months here. Now, before we get to that, a couple of you said I speak in jargon. Financial jargon is what some people said, maybe just 2 or 3 people, but I want to clear this up. When I talk about the bond market, that is the key to the economy. The bond market is also known as the debt market. And what happens is banks have been selling off securities, bonds, treasuries, of basically bundled loans, which is debt. And when you have the central bank buying these things, it allows more lending because the lender never has to worry about the repercussions of loaning out the money if there's always going to be a buyer of the debt. So it's basically taking the debt off the books of these banks. We saw the balance sheet of the Federal Reserve go up to $9 trillion. Well, now they're unwinding that and they're not buying as much debt. That's why we're seeing yields spike. You see, when there's always a buyer, the yields don't have to be that high to attract the buyer. Do you understand? So now with the Fed backing away and not buying as much and actually unwinding their balance sheet, it's down to about 8.74 trillion, by the way. Now yields have to increase to attract investors because who wants to buy an investment product that only yields 1 or 2%? So now yields have to increase to attract real buyers, not just the central bank, but actual real investment firms, companies, investors. You understand? Hopefully that makes it clear. I try not to be over jargonistic here or too business-like. I don't even wear a tie. And some people come on here with collared shirts and ties, to try to make themselves look more professional. But I think it's the information that's the most important thing. But let's talk about what's happening here. A few recent news articles. And on the topic of bonds, bond yields are still rising. Last week we hit about 4.45%. We're down to about 4.23%. What does that mean? Anything over 4% is danger zone for mortgage rates. So we're going to see continual elevated mortgage rates and rising mortgage rates if this continues. I hope it does continue. Let's talk about what David Rosenberg said. David Rosenberg, he's been pretty bearish on the economy. Basically, he knows how leveraged it is, how much debt has pushed up these asset prices. He's predicting a 30% hit to home prices. 30%. I think it could be much worse than that if rates are allowed to rise. Also, he sees the S&P 500 going down to the 2020 levels. I think it's going to be much worse than that. So someone that's a bear is actually out saying these things. He's been pretty bearish on the economy, but I think it's going to be much worse than what he's saying if rates are allowed to rise. I always have to say that. People say, I make predictions or I change my predictions. When things change, I change my prediction. If the Fed cuts rates, if they start buying more bonds and bond yields plunge and mortgage rates are going to plunge with it, I'll change my prediction. But right now we're seeing deteriorating economy, housing market, car prices coming down. basically anything that consumers borrow money for to buy, you're going to see deflation, except for people say, well, borrow money, that can mean a credit card. Technically, you're borrowing it. Hopefully, you're paying it back in full. I'm not talking about food inflation, fuel, energy. We're still going to see inflation in that. Now, yes, gas prices have come down. The price of oil per barrel is down to about under $85 now, which is a good thing. But remember, we're draining our reserves. We're draining our reserves. We could see a spike in fuel prices. They're going to cripple the economy. And I mean cripple, not just the economy, but cripple everyone's everyday activities, like come to a screeching halt. Can you imagine a spike in oil? Once these reserves are drained, the spike in oil that we might see, is it going to be 150? Is it going to be 200 per barrel? Is a gallon of gas in California going to be $8, $10, and the rest of the country $5 and $6? It's possible. We are draining our reserves. And there's people out there that say this is good. We need to switch from gas to other types of energy. And maybe we do need to switch, but it's going to be a painful switch, and it could be a collapse, and it could be a lot of carnage. Like I said a few reports ago, we're only 72 hours from chaos from the time when trucks stop delivering goods and products, and we're going to see a diesel. There's a diesel shortage happening right now. They're saying diesel could run out too. We can't prove it one way or another, but that's what the reports are saying, that supplies are historically low. But when the trucks stop running, you only have a few days before Mad Max, before chaos ensues. So it could happen just like that. And I know some people say that's fear mongering, and but it's possible. Telling you to wear your seatbelt in your vehicle, is that fear mongering because you might get into a crash? No, crashes happen every day, all the time. There was just a crash on the freeway earlier this morning. I was driving my kid to school. There was a car on the side of the road, flipped over. Things happen. Bad things happen. And if you're prepared, hopefully they won't. If you're driving slow, if you're looking out for other people, if you drive defensively, hopefully you'll be less likely to get into an accident. Of course, sometimes things happen even to the best of drivers. And it's similar when it comes to financial preparation. I think a lot of us here on this channel, we saw the writing on the wall a long time ago. This market should have came down a few years ago. Remember, the Fed tried to raise rates at the end of 2018 going into 2019. We had an individual out there putting out tweets telling the Fed not to raise rates. I was very, very disappointed at that. But of course, nobody wants this coming down on their watch. And maybe we have a guy up there now who has no idea what's going on, quote unquote leader. And he doesn't care that the Fed's raising rates. He's just putting out his talking points, and he's really kind of oblivious, doesn't understand what's going on. Maybe that's the scapegoat for the economic collapse. Maybe the Fed's going to bring this whole economy down, and they'll point the finger at goofball out there, and that's the way it's going to be. I really hope that's the way it's going to be. I hope that the market crashes. We need a correction. We need to see some real price discovery without the buyer and lender of last resort keeping all the asset bubbles inflated. Well, now we've got a double, triple, quadruple whammy, because we've got shortages. We've got the consumer being crippled. We've got farms being crushed under inflation and shortages. We still have shortages of fertilizer and fuel. Fuel is nailing a lot of farms as well. So food inflation is going to keep going. Fuel, energy is going to keep going and actually go back much higher, in my opinion. Homes, automobiles, two areas that we're going to watch for deflation. So continue to use caution, stack accordingly. And thanks for watching this report, everybody. Keep stacking. Bye for now. Peace.